Welcome everybody. Thanks for joining the session tonight. We'll just wait a couple of moments until everyone joins. We want to make the session as interactive as possible, and so maybe we can actually start off by finding out where everyone's from that's actually joining in tonight. And it'd be great. This is, the great thing about our format tonight is you guys actually get to really direct where you want the discussion to go. So if you have particular questions you want to cover off around, grants for startups in the UK, different innovation funding that you can avenues you can tap into, or in particular around the SEIS and EIS schemes, incentives for investors in the UK, please put some notes in the chat now. We'd love to actually get some direction in terms of the areas we'd like to cover off. And then if you can do that, that'd be fantastic. And then we'll get started in a moment. It sounds like, are you in an office, Farah? Where are you tonight?
I'm in London, in sunny London, from my flat, actually.
Excellent. And everyone else at home or offices, or where are we?
Yeah, at home at the moment. Off to the office. We actually just switched offices, so we're in Hammersmith now. So it's like a 10-minute walk for me. I've never lived 10 minutes from my office ever. So excited about this week.
Excellent. Hey, Dylan.
We've got Dylan calling in from Gold Coast, one of our team.
Thanks for joining us. We might kick off. I think there'll be some more people joining us as we go through. So just an introduction to myself. My name's Callum Davidson. I look after partnerships at Cake Equity. Cake Equity is a SaaS platform that helps founders streamline capital raising and also employee equity. Any founders out there that are joining the call tonight, if you haven't run a funding round and you're about to, then you actually understand just how difficult and confusing and complex that process can actually be. So we exist to really help streamline the whole process around executing capital raising, keeping your investors engaged. So once you run one round, you want to keep them engaged and you want them supporting you through subsequent rounds as well. And then the other issue that we help founders out with is the employee equity. And we all know, particularly in the hot startup market that is 2022, that the war of talent, particularly engineering and technical talent, is enormous at the moment, right? And so having a good equity incentive plan as part of the mix is really critical in terms of being able to attract, retain, and reward your teams. And so we really help streamline the whole process behind setting up your employee equity schemes, and then managing them on an ongoing basis and making sure your team have visibility over that, so they're valuing the equity that you're actually giving them at the end of the day. So we're really pleased to bring tonight's event, today's event to you. We have a great panel. We've got Nathan from True Altitude, who's a VC, but a sort of a VC that's probably a Swiss Army knife of VCs, I think. When you talk to Nathan, the team, and you realise how much they do just across the whole startup space, from actually facilitating accelerator programs to various other things, it's actually quite amazing. And Nath is a real expert around helping founders navigate through, particularly the things we're going to talk about tonight, which is the SEIS and EIS schemes as well. We've got Olaf, who's our grants expert and innovation funding expert. He was just saying earlier how busy 2022 has been, with really an explosion and a real impetus in terms of the amount of funding that's going into the startup space in the UK, which is absolutely fantastic problem to have for all of us. And it's great to see that level of support for the ecosystem. And even though it's generating you some headaches, it's a welcome problem to have, I'm sure. And it's fantastic to have Farah on board as well. It's always important in these events, I think, to actually have a founder's perspective. So it's great for us to actually talk about us as service providers and investors, etc. But Farah has actually been through the process, so she can actually, she's not just talking the talk about how this works. She's also walked the walk, and it'd be great to get your perspectives as you've gone through, and hear about your learnings as you've gone through it as well. So I'll just throw it over to yourselves to actually give a little bit more detail on your background. Farah, maybe throw to you first.
Yeah, of course. Thanks for having me. I apologise in advance. I am going to be coughing a lot, so if I do, I will mute. So my name is Farah. I am the co-founder of Hanx. Hanx is a sexual wellness brand designed with women in mind. We launched in 2018 as a very small team, my co-founder and myself. And really a challenger brand, so disrupting the sale category that's out there, which is dominated by the likes of Durex, etc. In terms of sort of our brand angle and USPs, we're gynecologically backed, kinder to the environment, etc. My previous background was actually in investment banking, so I was at Goldman Sachs for just over 7 years, so a very unrelated background to sexual wellness. However, my co-founder is a gynecology doctor specializing in sexual health. So as you can imagine, our responsibilities in the company, I focus on finance, fundraising, and the lovely EIS and SEIS applications when they come through. So yeah, brief background on myself.
Awesome. Olaf, great to...
Good morning or good evening, wherever you are today.
Sorry, I can't hear you, Olaf.
Oh, can you hear me now?
Hear you now, yeah.
Yeah, perfect. My name's Olaf Swanzy. I am here representing the P&O Group today. P&O are Europe's leading innovation funding consultancy, so really the biggest practice in the grant space. Each year, we typically raise about €1 billion worth of external funding. When I'm talking about external funding, I'm talking predominantly about grant funding, and that'll be grant funding from national and European funding providers. In terms of me, I've been in this market since 2004, so scarily over more than 18 years now. I think during that time, I've been involved in pretty much every single major R&D funding program, and that's really where my expertise lies, good and bad. I've also been a fund manager for the European Commission, so I've kind of seen it from the other side as well, not just kind of in the helping organizations to identify and secure grant funding, but also supporting grants of bodies actually administer the funds. So hopefully between all of that experience, I'll be able to give you the good and bad and ugly and all the kind of key considerations when it comes to the pursuit of grant finance for your business.
Awesome. Thank you. And Nathan.
Hi, yes, Nathan Kelleher, partner and co-founder of True Altitude. True Altitude, as you mentioned, Cal, venture capital, fundraising. We've been involved in probably 25 investments in the last few years, quite a few of those EIS and SEIS. So we've subject matter expertise there. We also have an advisory side of our business that helps companies in navigating EIS and SEIS as well. And that be Australian businesses, US businesses, and obviously local UK businesses.
Awesome. So why don't we kick it off? Let's actually start with looking at the investment schemes in the UK. So Nathan, maybe actually just kicking over to you to actually, can you give us a little bit of a rundown? I mean, a lot of people will be familiar, but what is SEIS? What is EIS? What are some of the differences between them? And then also just get an understanding around sort of eligibility for those.
Certainly. So EIS, obviously, anytime acronyms are thrown around, people don't really know what they mean. But Enterprise Investment Scheme and Seed Enterprise Investment Scheme. So they were introduced by the UK government in 2012 to drive investment into early stage businesses. Obviously, around the world, people have different things. I know in Australia, they've got sort of things like export market development grants and the such. However, the EIS is quite unique in the fact that what it's trying to do is actually bring high net worth individuals into investing into early stage businesses. So anytime you're in a startup, it is difficult to raise funds at times, and this is trying to offset that by giving tax incentives to people to invest in the businesses, and basically reducing the risk into investing into early stage business.
Right. And like I've read some stats that, I think something like $23 billion has been invested via the schemes since they've been introduced, which is, obviously a very significant amount of funds, particularly when you consider the average size of a startup, particularly an early stage investment. What sort of percentage of early stage funding is actually done via these schemes? Do you have any idea of that, Nathan? Any sort of estimation?
Yeah, it's I don't know the exact figures. I don't think they're widely spread, but certainly in regards to the startups that we speak to and the startups that we've engaged with, EIS is top of mind. Certainly, there's very few industries that can't get it. There's a bit of conjecture around finance. Certain types of finance, certain types of insurance companies. Beyond that, manufacturing. If you're manufacturing products, sometimes it's difficult. But beyond that, certainly in the tech space or in sort of B2C space, this is a highly used area. EIS is, I guess, a difference to, crowdfunding's become popular in the last couple of years, people going to crowdfunding, but crowdfunding's got its difficulties. It's got benefits for some products, but a lot of people don't have a lot of success doing crowdfunding. So EIS gives you the opportunity to get early stage investors in who would have connections, would have the opportunity to introduce you into their networks. And the fact that it introduced you into things which we'll probably cover a bit later, but areas such as family offices, which are highly valuable to an early stage business to get them into people who will invest at later stages as well.
Yeah. Okay. Farah, it might be good to actually just throw to you on this one. Is like, what's your experience? I mean, you're a little bit unique in the fact that I suspect your investment banking background really means that your radar is probably more attuned to some of these sort of schemes than the average founder. But kind of amongst other founders, like what's the level of awareness around the investment schemes, and then also for most founders thinking about how they actually go about tapping into funding from investors who are actually investing under the schemes. Did they know where to go, and like how did you go about that when you were starting to raise?
Yeah, so a big proportion of our funding to date has been through angels, so sophisticated investors, mainly in the UK, a small proportion internationally, and so with it being angel investing, that EIS and SEIS is favourable. SEIS being, I think you get around 50% in terms of rebate, whereas EIS is 30%. I think it's only the first 150k that you raise as the SEIS eligible. So in terms of investor appetite, that first 150k, knowing that we had the SEIS advance assurance, was super attractive for investors. And actually we filled that quite quickly. In terms of the process of finding investors, despite my background, is actually very difficult because it's a different ball game altogether. And finding those kinds of investors versus institutional, and it can be seen as quite a risky startup because it's competing with a big challenger, a stale market, so to speak, more a challenger brand. But going to networking events, looking at different angel syndicates, especially ones that are EIS friendly, where they will also have a target on their head to fill a certain number of their portfolio with a number of EIS eligible startups. So that's been helpful. But I do think generally in the UK, if you are an angel or an individual investor, I'd be surprised if you didn't know about EIS or SEIS.
Yep.
And that often is an attractive piece. And especially when it comes towards the end of the tax year, when people are looking to fill their allocations or make the most, of the tax efficiencies, then it becomes quite popular to look at startups like Hanx. In terms of sort of the process, so when we first launched, we had never heard of SEIS, EIS, it was new to us. But having spoken to a number of other startups who'd been through the process, the first step is advance assurance. From my experience, it's quite a straightforward form to fill in on the HMRC site, or you can get an advisor to help you fill that in. And it acts as a certificate and almost it's not a guarantee, I have to point out, but it gives the investor an assurance that HMRC have provisionally looked at your company and think that it would be eligible when the time is right and you get the funding. And that does act like a security blanket when you are speaking to investors. But once you do get the funding in, you do have to go through a formal application process. And there's a number of ways you can do that. You can do that through an advisor, your accountant, or yourself. I like a challenge and I'm quite boring, so I do it myself. And each time I do it, I'm like, why the hell am I doing this? Like, I have so many other things I could be doing. But I've just completed a process. And I think the key things to be aware of are valuation and lifetime allowance, which keeps cropping up on these applications. So how much you've raised to date that has been EIS eligible. I don't know what the limit is on valuation, but there is a cap on that as to whether it's eligible. So being aware of that as you do the rounds, because once you get the EIS assurance, it's quite easy to think that you'll always be EIS eligible. But just being aware of the rules and any nuances before you get the cash in the bank, I think is important.
Nathan, have you got anything to add to that in terms of process? And
yeah, I think, well, I've invested twice into Hanx, so that process does work, and she does very well at it. So it's we got all the certificates that we need, so that's good. But yeah, just in regards, so to understand, you can raise up to 5 million a year under EIS. So that's significant, for a startup. So I don't know too many that have hit that cap. The maximum you can raise is up to 12 million, and then you're out at EIS. You've also got a period of time, so you've got 2 years to activate on this. So you can't just throw it out there and then just leave it. You've got to be actively doing it. And probably the key too is those funds need to be spent. That you can't just bring them in and just sit on them. You've got to be able to use them and make them active within your business to grow, because that's the whole reason why the government's doing it.
Usually not a problem for most startups, so spending it.
It's not. But what it does do is it stops people. And one of the keys with this is stopping, like real estate developers or whatever, just raising money and just sitting on it, and just thinking this is a good way to make money. No, it's being used correctly. And you're right. Every startup has spent the money already before it comes in normally. So yeah, it's a good scheme in that sense, that it's very heavily monitored and making sure that people are doing the right things.
And in your experience, Farah mentioned the fact that she's a glutton for punishment, so she ran through the process herself. In your experience dealing with the founders that you're investing in and dealing with, are most of them using their accountant to actually do that process, or are they doing it themselves, or is it a bit of a mix? Or
yeah, typically it's the accountant. Most people won't go down that path. They're not as a glutton for punishment. But yeah, no, I know the ones that we work with, we've got some trusted accountants that are independent. Obviously, people deal with them directly, but they've done, like, we know the accounts that we recommend to people have done probably 40, 45 of these, so they're used to the process and can sort of run through it. Now, what you get obviously with that is you don't get the insight that probably Farah's got, so, people are handing it out and then you get it back and you go, great, we've got advanced assurance. Well, that's great. And then, you raise the money and you just need to understand that. But I think certainly in terms of the process, there is a lot of help, obviously, in the UK market for people to do this. And, it's a well-known process. So it's certainly not something that's going to be a shock to an accountant.
Yeah, I'd agree with that. And I'm a chartered accountant as well, so I need to do this to keep up my my annual experience. But on that point, Nathan, you're right. So investors will then ask questions about once they've invested, like, when do I need my certificate by, or can I get it, and my tax return. And often I don't know the answers, and I know the answers from the business perspective. And so by doing the application, you become more aware of what that means for the investor. Now, naturally, I would always say, look, go speak to your accountant or go to the HMRC site, because I can't advise on that. But by going through the process, it makes you understand, what it means for the investor as well, and the implications as a business. And for those that are starting out, definitely I'd recommend just getting an accountant or someone that does this day in, day out, and it's their bread and butter, and they can easily churn this out.
So Farah, you made an interesting point earlier on, or you sort of mentioned as you were talking about your story, about the fact that you were actually looking and talking to some investment groups that had specific basically allocations of funds that they wanted to put under these schemes, and that. A challenge for founders is always actually, how do I build my investor list? How would I find investors? So how did you go about actually understanding which were the investors that might want to actually be doing that? And you also mentioned the kind of the fact that there could be more demand around the end of the tax year and that. So maybe you could actually put some light on that also.
Yeah, so if you'd have asked me 5 years ago, I wouldn't have a very clear answer for you. I feel like a lot of it was networking events, going to events that were related to startups or female founders, and building a database through that. Now there are so many resources out there online. You can look up funds that focus on consumer tech, female founders, SaaS, etc. It was about the ones that were easily accessible to me, so ones that were London relevant or in the UK. And going through that investment raising process does feel like a numbers game. It feels like a sales process. You have, a list of 100 investors you work your way through. Only a certain percent want to meet you the next time and go through due diligence, etc. So every time I finish an investment round, I'm like, I don't have a clue how I did that. I need to get better at the process. So it is a learning process throughout. I don't think there's one rule book as such, but certainly what's helped is sort of being open to sharing information with investors to an extent, and also asking them for help, right? Even if they don't invest, do they know anyone else who may be interested in investing, and staying in touch with them as well. So really keeping and building that rapport with them, whether they invest in this round or future rounds. And then you had a second question, but I've forgotten what that is.
I was just asking about, like, I also you made a reference in terms of timing of the tax year and the investment when they're looking to deploy more of these funds. I just was actually asking about that.
Yeah, so as Nathan said, you do have, from a business standpoint, you've got 2 years to actually submit the application and get certificates in. From an investor standpoint, I'm not 100% sure, but what I sense is around September time, it feels like, is when most
And now before the end of the financial year.
Yeah. So like 5th of April being the end of the financial year. Some investors get confused because they've just done their tax return or are about to do it in January, and they're like, I need the certificate quickly. And we're like, well, it doesn't apply for the last tax year. So it really depends on how sophisticated the investor is and is aware of that. But from a fund perspective, we find when we've gone to smaller funds, and even have briefly spoken to institutional, by September, they have already allocated a big proportion. But you're right, April the 5th is the key time. But Nathan, this is a question from me as well, actually. So when you say the 2 years, does that mean they have 2 years to bank the certificate from their tax return for the
you've got 2 years to you've got to be active within 2 years. So there's you've got to have raised funds, you've got to be basically working on it, so you can't get advance assurance and then just sit there. And the business has to have been started in the last 2 years effectively. So you can't go for an EIS if you've been around for 10 years. It's a startup. It's meant for seed, it's meant for early stage. So you've got to have activity, and you've got to be brand new, in terms. Now obviously you've got a period of time after that, and you've got up to 12 mil to raise, so that's going to take a period of time, but it is targeted towards early stage.
Got you. I think the only other thing I'd add is, even though the process can be lengthy, when you go through advance assurance, you often have to, this was 5 years ago for us now, but you often have to submit a business case, like a business plan, and what you plan, what the business is and what you plan to do. And a lot of that God, it would scare me to look back at our business plan 5 years ago. And for you, Nathan, as an investor.
Throw it at the wall. Early stage business,
yeah,
right?
Let's not talk about that business plan. But you've done a lot of the legwork, right? So if you've got your advanced insurance and you're raising cash within the year, you've done a lot of the legwork, so when it comes to doing the application or providing information to your accountants, a lot of that is done.
Awesome.
Yeah, definitely. There's checklists there, and and we'll obviously talk with Olaf and soon about the grants as well. But obviously, when we sit down and work through a checklist, we've got a whole list of things that people need to submit. And 2 years ago, it was relatively easy. I think they've tightened the reins a bit. I think during the pandemic, there was so many new businesses started. People are at home. But HMRC's started to get a bit tighter and make sure that it's legit and companies are really doing what they say they're going to do. So I think it has tightened up a bit, but I think that's a good thing because for companies that have EIS, you don't want the market flooded with basically crap. People not doing the right things. It's if you're a founder, as Farah and Sarah, you're going to market with a legit company and product. You want to have legit EIS scheme behind you, which they've been successful with.
So it sounds to me from what we're saying here is really like, if you're an early stage startup, obviously the schemes don't guarantee you getting funding. At the end of the day, you still got to do the legwork, you still got to do the hard work in terms of actually convincing the investors that you're the right startup to actually back, and you've got a great team and some unique insights on solving a meaningful problem. But it also sounds like it's going through the schemes is pretty much table stakes if you want to actually get early stage investment in the UK, because it opens up that whole range of benefits for your investors.
Yeah, exactly. Because there's a few different types of investors. There's the angels or high net worth. You can bring them in just through. You've got to do the legwork. You've got to know people. But really, where you want to also get into, which a lot of early stage businesses in the SEIS as well, is the family offices. So if anyone's not familiar with family office, it's a syndicate approach to a whole lot of high net worth individuals who are maybe not as sophisticated investors, or they might still be sophisticated, but they're spreading their risk. These funds have money to deploy into businesses. They like SEIS. They'll take EIS. The benefit that an investor gets is that you've got shared risk. So they're taking, they might do 10 investments rather than one, which means that from a founder's perspective, you're getting access to a lot of investors, but your cap table, which you'll like, Cal, is very clean. It's a single point of connection, but you're getting access to a whole lot of future potential, follow-on investors. So, they're very prevalent in the UK, and some very successful family offices that we've got relationships with who have done investments, co-invest with us. They've directed investments our way. It's a great scheme, to be able to use for those.
Fantastic. Now, Olaf, I know you've been sitting there patiently. Thanks very much. So, so we do the investment schemes. We've still got to go out and find the investors and actually, get them to invest in us. If we do if we go through the grant side and we get approved, we actually get the funding, which is one less step in the process. So can you talk to us a bit about that? As I said, one of the first comments you made tonight coming on board is that there's just a lot of actually funding going into the whole grants and innovation space and the startup space. It'd be great to just get your perspectives around that. You've been around for a long time. So I'd also like to maybe even if you could highlight a few of the main ones that you see most commonly being used, particularly by early stage startups in the UK.
Yeah, thank you. Actually, but I've been learning a lot this morning myself, so it's been quite interesting to listen to Farah and Nathan, actually. So in terms of grant funding, I would certainly urge all startups to consider grant funding as early in the process as possible. Now, naturally, you have to have a registered company in the UK, and you have to be incurring expenditure in the UK, including PAYE staff, to be eligible. And I can talk through some of the eligible costs a little bit later on. But I would urge all startups to consider grant funding as a potential avenue. The reason for that is obviously there is a fiscal benefit. It's non-dilutive, so you're not giving anything away at all, which is of significant value for many companies. But also there are many non-fiscal benefits of receiving grant funding in the UK, and I would say a couple of those ones are helping you to actually kind of sit down and actually plan the business plan well. So going for a grant application is actually a really great skeleton for a business plan. I mean, Farah mentioned about some of the sort of challenges that she had in her startup in terms of writing business plan, how much it's changed, but actually going through the grant process actually helps you to kind of sit down and really understand the market that you're looking at and all that sort of stuff, which would be required for follow-on funding. In terms of follow-on funding, we work very closely with investors, angel networks, VCs, and why they look at the companies that we've been involved in is because they have secured government funding for their projects. It is a quality stamp. It shows that you are very well placed in terms of your focus and your business. And actually, we have a massive success with companies looking for follow-on funding who have been awarded grant funding in the first place. In terms of grant funding, as I said, it's non-dilutive. The typical grant in the UK, it does vary, and obviously it depends on the stage of your journey and what sort of TRL and the level of maturity that you're at. But certainly the average grant, I would say, is between sort of 200 and 300K, which is a massive boost. Grants can be up to 70% support for most projects. So you still need to consider where that match is coming from, but certainly 70% funding for a startup is a massive boost. And it can cover you for projects which are typically between, I don't know, the average duration is typically between 12 and 24 months. So it's a good roadmap, and it gives you a good sort of headway in terms of accelerating your business. Now, the types of grants that are available really focus on research and development. So companies that are, it doesn't apply to all companies. I think that's something I need to be very upfront about. You have to be the right type of company to be securing support. And it is always for product development, and it is always for or product or process development. In some cases, services as well, but generally you are conducting a program of R&D from which a new product, process, or service will emerge. I would say some other key considerations when it comes to grant funding, certainly it is for companies who are doing something which is, I would say, addressing a big, not only a big market opportunity, but also addressing a societal need. And that's quite a key thing to really flag. You need to consider how your company and your product is actually addressing a recognized government challenge. Now, whether that's agri-tech, healthcare, ICT and digital, you need to try and consider the angle, which is why I say I made the statement before that grant funding is not suitable for all businesses. Companies like Dyson, for example, probably not the most grantable, despite their, obviously their commercial value. So it is about, selecting the type of program that's available for you. But in terms of going back to what you said before, Cal, there is a lot of money going around, particularly for startups. I mean, the UK typically invests, well, certainly bodies like Innovate UK, which is the main R&D funding body in the UK, they typically fund around about 7.9 billion a year. So, there are a number of programs in terms of open ones, which are open to all sectors, but also thematic ones that I would certainly look at as early in your company process as possible. Yeah. I'll stop prattling on. If you want to ask me some more questions, that's fine. But yeah, definitely worth considering for any company, regardless of sector.
So just picking up on one thing that you mentioned there, right? So you mentioned the term it's non-dilutive, right? So obviously, if I've got two co-founders and we own 100% equity in the company, if we go out and raise from investors, then that dilutes our ownership percentage. But obviously, if we're tapping into grant funding, that's not equity funding. Therefore, we maintain our ownership percentage. So it's really important that people actually understand that, and it can be a process to go through for the grants. But as you said, can be a great one from that perspective.
It is, and the process is the process. I'm not going to sort of lie to you and say it's straightforward. It's not straightforward. It takes time putting a grant application together. but it's a really useful exercise, and it's exactly the same questions that an investor would ask you. What is the market potential, the quality of your team, the route to market, the pricing model, the impact? It is a really valuable exercise to go through, even if you don't get the funding in the end. But sitting down and doing that grant application really consolidates your view. In terms of the non-dilutive aspect, Cal, the reason that grantor bodies fund early stage businesses is because it's high risk.
Yes.
So, if you're delivering a program of research and development or product development, you are going to be taking risk in doing that. And that's why you try to leverage grant funding to help you commit that resource and to progress your company journey. But it's a very useful process to go through.
And most founders come in, Olaf, they've probably got no idea where to start with any of this. So, what advice would you give them in terms of thinking about like how they actually make themselves aware of what grant opportunities are out there? And then also, how do they think about the process? Like, do they try to do it themselves? A la Farah with the SEIS and EIS, although we've already discussed that she's probably overqualified to actually run that process, as opposed to most founders, or do they actually get an advisor? Where do they find an advisor? I know, obviously yourselves have helped a lot of startups through that process, but it'd be good to understand that.
Yeah, so in terms of starting point, I would say you look at Innovate UK's funding pages. So Innovate UK, as I said before, the main funding body, particularly for startups in the UK, and they run competitions or calls throughout the year. So the types of calls that are available will be open ones, which is open to all industry sectors. It's about funding the best projects. So the flagship scheme that Innovate UK run, which is open to all sectors, is the SMART program, which is about 100 million a year. They typically deploy that across 4 rounds of 25 million. And of that 25 million, they would typically fund between 65 and 85 projects per round. Okay. That's the starting point. So Innovate UK publish competitions all of the time. And the other types of programs will be thematic calls, where there are kind of key challenges that the UK government have announced. So it could be around things like we're looking for innovations for healthcare to address kind of big healthcare challenges. And then companies can then apply to those thematic calls. Chances of success are always going to be slightly higher under thematic calls because obviously they're much more targeted. But certainly applying for a scheme like SMART, one of the open calls, before you even apply for a thematic call is a useful exercise to go through anyway. In terms of how, so looking at the Innovate UK competitions page, they're very good actually. They give you a long lead time, typically about sort of 8 to 12 weeks from announcing a call to closing a call. So it's worth kind of registering with Innovate UK, and they will then send you details of competitions that are relevant to your sector. In terms of how you actually go about applying, obviously you can use an advisor. There are a number of good consultancies out there, and obviously including P&O. But most companies do actually do it themselves. And if you fully understand your business, you fully understand your market, and you do the simple things, which means following the guidelines for applicants and really following the guidelines for applicants, there is no reason why a company can't obviously be successful themselves. But you do need to allow at least 2 to 3 weeks to write that bid to do it justice. It's not a tick box exercise. It is something which you have to really spend some time doing. But as I've said a couple of times today, it is a useful exercise to go through.
Fantastic. Any other tips, Olaf, in terms of for founders?
Yeah,
around?
I would say well, I've got many tips for how to be successful, but I would say a few things definitely to take into account. Number one is follow the guidelines. So bodies like Innovate UK, they really give clear instructions as to what they're looking for. That's the first thing, an obvious thing, but you'd be surprised how many companies overlook that. Second of all is really understand your market. That's what separates the successful applicants and the failed applicants. If you understand the needs of a market, you've even engaged with a potential customer base, and the same thing will apply, looking at, for actual dilutive funding or conventional funding. But if you've engaged your customer base, you know their needs, you know their weak points, and you know what products currently exist out there that do that, that fulfill that gap in terms of kind of current state of the art and the reasons that they're failing to address that need. Those are the key things. I think the other thing that I would definitely encourage all applicants to consider is the quality of their team. Grantor bodies look at technical competence, as in, you know, do you have the technical expertise on board to deliver a particular project, but also the commercial track record of taking a product, comparable product to market. Now, as a startup, you might not necessarily have that commercial track record. In that case, I would urge everybody to create some sort of advisory board to the company, you know, people who can kind of guide your journey, people like Nathan, for example, who could, you know, have experience of commercializing products. So that's definitely something that we see grantor bodies particularly favorable around.
Fantastic. Great advice there. Farah, maybe it'd be good to actually just delve a little bit more back into your background and in terms of with Hanx, what fundraising stage are you at? How many rounds have you raised? It'd be great to get some more delve a little bit deeper into your journey.
Yeah, of course, happy to. So when we first launched the brand, we actually self-funded to get the product to market. And that was mainly through a lot of rejection. So we had this great idea and we spoke to lots of investors, mainly institutional investors. So that was naivety on our part. And a lot of them said, we want to see a bit more traction. And they probably didn't believe in us at the time, being frank. So Sarah and I put our life savings into Johnny's, much to the disgrace of my family. You were thinking, what are you doing quitting your jobs, launching a condom brand? So there was a lot riding on that. But once we launched the product and were able to get it to market and the brand, we then went back to those investors. And actually still, we were a little too early for institutional at the time. This was around 2017, 18. But some of the people that worked for those institutions said that they would invest personally. So we did a small round of 150K. That was our SEIS round. And we filled that quite quickly, I think with 4 investors. So that was a chunk of cash. And then we were able to sort of build on that, prove out some points of that 150K. And then we raised again. And honestly, every time I raise, I'm like, this is going to be the last raise. Like, this is fine. But as soon as I've closed a round, I somehow end up raising another round. So we've done about 5 rounds that have taken us to just under 2 million of funding. Yes. Every time we've done a round, actually the first 3 rounds we focused purely on angels, yes, because of how early we were, from SEIS to EIS. About 50% of those angels at each group were either through networking events or through introductions with other angels who weren't going to invest in time or were and had said, meet my pal, so-and-so. And
that's
then
an interesting point. So quite a lot were introduced through people who didn't invest at the time.
Yeah, probably only because I was pushy and I asked them to choose someone else. So if I'm not getting your cash, can I get something else?
Yeah.
I think a lot of it is relationship building as well. You know, it might not be right for them at that point, or they may have just filled their allocations, or they're unsure and they want a few proof points, and that's fine. But you know, wherever I get a rejection, I do often ask, you know, what else can we do, and is there anyone else we should be speaking to? And you know, we're lucky that we've had people kind enough to introduce us to other people in their network.
I think that's a great tip, right, for all founders, right? So
yeah. And then sort of the 4th and 5th smaller chunks of rounds we've gone to bigger, you know, small VCs or sort of early stage institutional or syndicates as well, to sense it out. And every time we do a round, we get way more interest from angels, probably because the London Angel Network is very small. Nathan, you all know this. And the majority of people on our cap table who are from London, will know each other or will have connected through different groups. So there's an element of FOMO, which has been really nice for us. So by the time we've gotten to like the third, fourth, fifth round, people are like, oh, I missed out last time. I've heard, you know, my friends are missing out, can I come in? Which is great for me.
You need a little FOMO to close those rounds.
You need a little FOMO, because being honest, there's a herding mentality with investors. You know, no one wants to be the first one that puts in, but the moment someone does, everyone follows. So you need to build up that FOMO, which honestly I don't have a true science to, but it's happened to us before. So I'd say we have had funds that have got involved in the third, fourth and fifth round, very small, some family offices as well, like you mentioned, Nathan, but some small stage VCs. But we're at a point in the business where we can be profitable by 2023, and so we're in a tricky position where it's like, okay, do we continue to work really hard as a super small team, really lean, try and get to that point, or do we accelerate our growth and go gung-ho and get big VC funding? The last 2 rounds has been that difficulty for me. It's like, which way do we go? And we've been really lucky with the last 2 rounds in keeping with angels and smaller cohorts, and it served as well. But that's not for everyone. It really depends on what product you have and what your growth ambitions are and how quickly or how slow you want to go.
I've heard it described as startup porpoising, right? So you go and you know you raise, and then you're cash flow negative, and then you get back to where you're nearly like above water again, and you're getting to break even. And then you come up with a great idea about an adjacent market or something like that, and then I'll raise again and then go back again, right? So that's
you're
a
always
nice
raising.
Yeah, it's a nice problem to have, that, right? You know, so yeah.
Yeah, it's you know, I left finance and now I'm doing finance full time, but I never thought I'd be doing it in this context. But it is a full-time job, and I think that's one of the other things being in a startup. The sooner you can have, you know, if you've got a co-founder, you can't both be doing the same thing at the same time. Quite quickly, you need to make a call on who's responsible for what. And sadly, I'm responsible for finance, but that is my full-time job. So like, you know, nothing else can get in the way of that. And I think it's important to know it is really time consuming. So you need to be able to have the support around you if you're fundraising, so that you can focus on that.
Yeah. I think one of the comments that I identified that you made earlier as well, Farah, is my background is equity markets, but at the high end, you know, the big end of listed companies, and where I ran investor relations for one of the major banks for a number of years. And you know, I describe it as coming into startups and actually doing, you know, equity and fundraising is like learning another language. Even though the concepts broadly are similar, it's so different in terms of the mechanisms you use and everything. So even if you know a bit about what you're doing, you're still learning a lot through that journey, right?
100%. I've learned so much more running a company than I have when I trained to be an accountant or worked for a big bank. It is all very new, and it helps having that, you know, financial acumen, but I've never been an entrepreneur, and so all of that is very new. And I think it's about, you know, leaning on your network, your investors, and people who can help you learn and grow.
Nathan, it'd be great for you to put your kind of investor hat on for a minute and actually, you know, think, you know, from a VC perspective as well, in terms of, you know, what tips do you have in terms of, you know, founders thinking about fundraising and who they approach around funding, and even, you know, particularly in the current environment that we've got at the moment, which seems to be a pretty frothy one still.
Yeah, definitely. We it's crazy sometimes, because you've got brilliant founders, you've got brilliant products, you've got products that have great market fit, and you'll hear that they'll take 400 meetings to raise, you know, a couple $1 million. And then you'll have ones that seem completely disjointed, all over the place, you know, whatever, and they walk away with $2 million. And like, the number of founders I talk to get frustrated with that, like, how the heck are these people raising this money this quickly, you know, sort of thing. And there is no science to it, and it really is a timing issue. Hence why I think the best thing you can do is be prepared. So as an investor and someone who, you know, has seen a lot of IMs, a lot of term sheets, the key is that when someone is keen, you've got to get them the documents ASAP, you know, because in between me saying, yeah, I'm interested, I'll receive 4 more. and there is kind of that bright and shiny aspect to it, so we have found if you get the docs over straight away, people are more likely they've still got that euphoria, about what you've presented. And as a very good presenter or a very good founder, you'll make that decision very quickly, but, and often the ones that are disjointed in that, they're pitching a very good, compelling story. And if they get people to invest quickly, and into what that vision is, they'll get the money quicker, so I think that's probably the key. And what the EIS does is take away a bit of that concern, certainly at SEIS, if that company fails, you get your money back, so hence why people want to do that first 150. And, there is a bit of a fight for that in businesses. But EIS also gives you that tax relief. So you've got 30% of that back. If the business isn't successful, and a lot of startups aren't, people try their best, you have got money back, and you've got tax relief. That's a huge thing. Hence why this is so important. Going to someone to get money, they're trusting you as a founder. You don't have, you might have a business plan, but let's be honest, it will change. Very few. If you can find one that was day one and stayed the same through to Series A or Series B, I'd be shocked. So I think it is important to capitalize on the hard work and get documents across quickly. Be very professional with the way you do it, and make sure that there's no sort of hidden traps, or people don't perceive hidden traps in the fact that they say yes and it takes you 3 weeks to get a document to them. That's not going to work.
Yeah. Great advice there. We do have about 10 minutes to go, so if we do have any further questions to come through, I did have a question about cake, which I'll come back to in a little while. One question we did have from Eva on the chat was about, is there any document or record keeping you advise early stage founders to keep that will make it easier to apply? I'm assuming that, is that for grants, Eva, or is that actually SEIS? So just asking about record keeping and making, it's EIS. Any documentation or records they need to be keeping to make it easy for them to apply.
Yeah, I think what's important is to have, like, this is why working, unless you have this skill set that Farah does, working with accountants is important, because what they will do is make sure they've got everything. So you need to have a solid IM, business plan. You got to have all of your documentation in terms of your company house documentation up to date. Your cap tables, that's one of the things people ask for, is the cap table. If you've done SEIS, or even before that you did take investment from people, you've got to have a record of who they are, because that's going to be a key factor. I think any of your filing accounts, you've got to keep up to date. You can't fall behind. The one thing I love about the UK compared to obviously being in Australia for so long, it's very transparent here. You can see how a company's performing if they're keeping up to date with things. So if you don't have that, and this applies to grants too, but you've got to keep everything up to date, and it forces you to be diligent. And I think any of the documentation you've got, we've got a full checklist of what you need to submit. We're happy to provide that to anyone at any point, to just look at what you should have. And there is, it's not onerous, but there is good record keeping, certainly.
I mean, one of the things that stood out to me from the conversation tonight is that actually both talking about whether you're talking about applying for the investment schemes, or where you're actually talking about applying for grants, or whether you're actually talking about actually getting investors to invest in you, a lot of the information that you require, a lot of the hygiene stuff that you require is going to be common across all of those platforms. So if you're doing it to apply for advanced accreditation to be eligible for those investment schemes, that's also going to be useful for you when you're actually doing your investment raise. If you're actually doing it for your raise, it's also going to be advantageous for when you're doing a grant, and vice versa as well. So it certainly seems to be that there's a lot of commonality between the information you'll need to be able to gather, even when you're going through a normal investment scheme that you can reuse in these other elements?
A good tactic or a good process is to create a data room very early. Everything that happens in your business, populate it. You know, if there's investors, if there's good partnerships, you know, create a partnerships bit so that, you know, when you're going there, you can show traction. You're not coming in cold. And the worst thing is to sit there and spend, you know, as a founder, spend 3 weeks putting together all this stuff, and it takes you away from your business. You're best off just doing it as you go. And I say that I'm the worst at doing things like that, but you know, it is good practice, you know, and you should be doing that. And when you come the opportunities for grants and the opportunities for that, it's very quick for you to be able to respond to that. And, you know, make sure that you've got, because you lose stuff and you end up finding yourself going through emails and, you know, documents and, you know, different things like that. It's not efficient, you know, so be efficient and you'll get the best results.
Excellent.
Just want to add, Cal, just to that, because it's a really important point from both sides. Grantor bodies will almost want to hear about your journey. So having a key understanding of the key milestones that you've gone through, even the amount of money you've invested to date, I think, you know, having that clear visibility, and if you have that information readily available, my word, will it streamline the process. So completely endorse what Nathan's saying. Do keep records as you go through.
Yeah, excellent. I've got a question here for you, Olaf. Are there grants for pre-revenue startups that stack at raising Are there grants? So it's in the chat. Are there grants for pre-revenue startups that are stuck at raising funds? I'm not sure whether are stuck at raising funds for manufacturing. Are there grants for pre-revenues? Yeah.
Okay, I get the question. So yeah, I would say a lot of the grants aimed at early stage businesses are naturally aimed at pre-revenue businesses anyway. Most applicants that we will support will be pre-revenue, first of all, but they will still have an understanding of their market, and they will still be able to kind of put a 5-year, you know, revenue forecast together, even though they're not actually revenue generating yet. And in fact, one of the benefits, as I said before, of applying for grant funding is that obviously it's high risk, and in most cases that it's a funding option of last resort. In terms of a company in the manufacturing space, absolutely. Manufacturing actually is one of the key 6 or 7 pillars that the UK government is hotly funding at the moment. So if you've got an innovation associated with manufacturing, which focuses around sort of energy reduction, less waste, faster throughput, higher level of automation, dare I say it, you know, these are the sorts of things that would certainly get funding for the right type of project. If you have failed and you tried to develop a product and it's failed, yeah, my word, you look at grant funding. You know, as long as you have a comprehensive work plan as to what you're actually applying for funding for, then yes, it should certainly be considered. And I would urge you to have a look at the Innovate UK website on an ongoing basis to see dedicated manufacturing calls, or look at some of the open competitions like SMART that I mentioned before.
Excellent. Nath, there's a question for you in the chat just about, so you made the comment about you get your money back if the investor fails, just clarifying, you know, if you're investing, how does that actually work if you're investing under SEIS?
Yeah, so the SEIS firstly gets 50% tax relief, so that's attractive. You know, like SEIS is literally open doors. You know, it's the riskiest of risky. If the company does fail, off the top of my head, I think it's within 2 years, then you do get further tax relief. So you are getting effectively, you almost get all your money back. Now, the likelihood of that happening on startups is very high, you know, unfortunately. So, you know, they're trying to incentivize because they want to get those first lot of checks through. And as Farah will attest to, that first lot of checks helps the second lot of checks. You know, when you've got angels in there and you can talk to those, then you're not first check through the door. So, you know, it's a bit better. And I just saw one of the other ones pop up just around the due diligence process that we go through. So I'll just cover that quickly. So early stage, certainly SEIS, you haven't got a lot to go on. So but effectively, if I'm, you know, this is my personal feeling, is you back founders and you back markets. You know, that's what you need to do. the founders you've got to back, because you've got to trust that they're capable of seeing this through. You know, people can have a great idea, but do they have the guts and the heart to follow it through? And that's what you're backing. It's great to get tax relief, but 30% tax relief means 70% at risk. So, you know, you've still got to back those. Due diligence on an early stage, well, they're pre-revenue often. They haven't got anything. You're backing a business plan. So you're backing your own knowledge of where they can be successful. And as any good investor, you should feel that you can offer value. Otherwise you're just throwing money, you know, and hoping. You may as well put it at the casino, you know. So I feel that you're backing your gut instinct, and, you know, you're not always going to get that right. But, you know, we've been very successful. I think as True Attitude, we've only had one fail out of, you know, 25, 26 major investments. So, yeah, we've been successful so far, but it's a bit of potluck.
Well done. That's a pretty good track record, Nath. You know, most I think the rule of thumb, isn't it? You do 10 startup investments, 7 of them fail. 2 of them make okay returns, and 1 is your returns a majority of your portfolio returns. So
yeah, we've been, let's say we've been lucky, but we've also done, you know, backed founders that we believe would be successful. You know, so. There's a lot of, you know, we see a lot of IMs come through. You know, we could back a lot of things.
yes.
I back a founder, you know, and their willingness to see the journey through. You know, that's a key thing.
Fantastic. We're pretty much out of time, and I think we've got through most of the questions. Any kind of final comments just before we wrap up, Nathan? Any final points?
Yeah, look, I'd firstly thanks Cal and Cake for the opportunity. You know, obviously you're launching into the UK market. You know, recently I think got a great offer there. People need your services. That's the first thing. I think anyone who wants more information, certainly any Australian businesses that are looking at the UK, we haven't gone into detail how that works, but we've got a process in place. So happy to take anyone through that and explain, you know, how you can get access to this. You do need local presence. We can help with that. And yeah, mostly just thank you for the platform today. Thanks.
Farah, any final words of wisdom?
Yeah, thank you so much for the opportunity. And I think I've learned a lot as well, and it sounds like I need to get in touch with you, Olaf, on the grant side. That's an application I have not been successful in. But yeah, I think if you're a startup, you know, be eager, be hungry, don't be afraid to ask questions. You're always learning, and network the hell out of wherever you are to get the funding. Excellent. And Olaf?
Likewise, you know, thank you for inviting me here this morning. I echo what Nathan said. You know, if anybody would like additional guidance around the grant funding landscape or the process, I'd be absolutely happy to. I'd be happy to kind of talk everybody through that. I'll make sure, Cal, you've got my kind of updated contact details, so you can circulate those. But yeah, I'd be delighted to answer any further questions.
Excellent. Look, I'll actually we'll send a copy of the recording out from today. We actually have a UK capital raising toolkit, which has a link to a bunch of things like due diligence checklists and things like that, which can be really useful for startups as they're working through and preparing to raise, but also would actually have some applicability to the advanced insurance application and the grants as well. So I'll send that out as well. One thing that I think we all know is that actually getting investors and accessing capital for startups it can be a challenging process. I thought I'd just finish up today. Well, I had a conversation with a really a prominent VC today, and they talked about the fact that when you're actually doing a Series A round, you really need to have at least 50 to probably 70 people that you're actually talking to, investors that you're talking to in your initial list, and that seems like a lot, but I thought they used a really interesting analogy for talking about the mindset of how you actually approach that investor conversations as a founder. And he said it's like actually being an actor and you're going to a casting call, right? And so you're there to rehearse for a part, Each investor is actually looking for a particular type of actor to play the part for their actual role. Now, as a person who's going through the casting, it can be a nervous experience. But understand that actually, if you're not the right fit for that role, it doesn't mean that there's not the right part out there for you. So actually think about that mindset. Take Farah's advice and don't walk out the door just with a no, I'm sorry, it's not right for me, but make sure you get some contacts for some other people and some other words of wisdom from them as well as you leave that. But I thought that's a great way to actually think about it, because like even with the grant funding to help you along the way, and also the investment schemes to actually make it more advantageous to invest in you, it's still a process going through the whole capital raising process and actually landing those investors. So I thought that was a great analogy. I'll leave that one with you. I'll send out some links to resources. Thanks very much, Nathan, True Altitude. Thanks, Farah, for being very generous with your time. And Olaf, great insights today. And yeah, I'll send out contact details for the panel as well. If you want to actually hit them up, I'm sure they're happy to actually share more words of wisdom with you also. Thank you.
Thank you.
Thanks, everyone.
Bye.
Thanks.